Okay, good morning and welcome to episode 3 of the Anderson Report. I am Tim the Source Anderson. It's great to have all of the support we've had so far and to have people joining us again this morning. I am going to recap the market action from last week, talk about the averages, talk about the crazy week that we had. Now, it wasn't necessarily the craziest stock market week that we've had in a long time, but the back and forth and the every other day, one day up, one day down. Basically, we had 4 of the 5 days when the Dow either went down or went up over 300 points, close to 1.5% on alternating days. So it's an indecisive market that's reacting to headlines and also looking for direction. I think that we're on the verge of either the Dow is on the verge of either breaking up or breaking down about 5%. The NASDAQ clearly is in a mind of its own. It continues to make new highs. And the S&P is really threatening this big resistance level that has put a lid that is marked by the highs in June when the S&P traded 4 days from let's say 3190 to 3230, and then gapped down on that big 6% down day we had on June 11th. Has struggled to get back up toward those June highs. It's right there right now. It went out at about 31.85. So, just as a little bit of a housekeeping note, I do work for a broker dealer in the and nothing I say can really be interpreted or be meant to be investment advice. It is just analysis of what we saw last week in the market and what we expect to be driving the market going forward. And so let's just take a look at the market averages. Now, on Friday, the Dow did almost a complete reversal of its losses on Thursday. Clearly, there was some positive headlines on a potential vaccine for the coronavirus, this drug remdesivir. If I'm not pronouncing it right, just bear with me. And got some positive headlines that sparked a little bit of a rally early. And then we had other positive comments as the day went on, leading toward the fact that even though there's been some fits and starts in reopening the economy, we're going to be reopening. Disney World announced that they were going to have a partial reopening. They gave a date for it. I think it's in the not too distant future. It's not the initial date that they were looking for, but it's a little bit later in July than they had originally planned, but it's a step in the right direction. Clearly, there have been a major outbreaks of the virus in very large geographic, dense geographic locations where the virus had not had massive outbreaks before. But so far, it seems to be contained, and the large majority of people that seem to be getting infected, the average age is less than 40, where the big problem that we had going back into March and April was that a lot of older people who were much more vulnerable toward the virus, people that had what they call comorbidities, were getting infected, and that was spiking the death rate. Okay, so let's take a look at what the markets did last week. The Dow on the week was plus 1%. Now, keep in mind that we started the week down 1.5% on Monday. We rallied on Tuesday and reversed that. We had a little bit of an up day on Wednesday, and then we had this Thursday and Friday action at the end of the week where we went down 350 points on Thursday, reversed it on Friday. So really, to fight off all of that volatility and for the markets to still have a positive week, even though the Dow has not yet got above its 200-day moving average, which is about 26,240. The Dow is at 26,075. I'm viewing it right now as positive. And we will have to see what next week brings. Next week we'll start earnings season. And that will be a whole nother set of headlines for the market to deal with. But let's take a look at the rest of the market averages. The S&P 500 went out at 3185 plus 1.7% on the week, and the S&P is up 2.7% for the month of July, 7 trading days into the month. Okay, that's very positive on the heels of the S&P being up 20% in the second quarter. Okay. Now, the NASDAQ obviously just continues to be on fire, really just causing havoc with a lot of market analysts, market strategists, chief investment officers that are just trying to figure out, look, are these stocks, how overbought are these stocks? And what do we do with them at this level? The NASDAQ rallied on Friday. It rallied, I think, every day this week. It's made new highs 5 of the last 6 days. It's rallied like of the last 8 or 9 days. It's rallied every day but one. And where the first 2 times that the NASDAQ hit 10,000, it didn't cause, but it was followed immediately after with a very sharp down day. Think about this. The first day that the market closed above 10,000, a major psychological, what we call a big round number barrier for a major index, the following day, the NASDAQ went down 5%. Then that was on June 10th and June 11th. Then, less than 2 weeks later, the NASDAQ fought all the way back, got back above 10,000, closed at 10,100 the second day, so it put in 2 days above 10,000. And then the next day, on June 23rd or 24th, the NASDAQ went down 2.7% and closed at 9,900. So I wrote a piece as to whether or not NASDAQ 10,000 was actually a sell signal. Now, sometimes you do get this reaction in the market where things are anticipated, and then when they happen, it's almost a sell on the news. It causes a sell on the news reaction. That's kind of like buy the rumors, sell the news. If you hear that from time to time from market commentators. So I was concerned that, boy, now what's going to happen the next time we get to 10,000? How nervous are people going to be that this 10,000 level is just a level that the NASDAQ is going to struggle with and almost take as a little bit of a warning that 10,000, do we really belong here? But clearly, the NASDAQ has done what it really needed to do to convince people that the fundamental story for these companies, and you know what the names of them all are: Facebook, Google, Microsoft, Nvidia, Apple, et cetera, Amazon, that have been driving what I call the internet traffic trade, which means that the traffic and volume of stuff on the internet, from streaming to working at home and everything else that supports it, I call that's the internet traffic trade. It's gone up. The traffic's gone up tremendously after the shutdown. And now the NASDAQ is over 6% above the 10,000 barrier. So even if you had a 4 or 5% pullback, you'd still be in a very powerful uptrend. And you'd have that 10,000 support level, which is probably going to play out to be a base for whatever this next leg in NASDAQ becomes. Now, if the fundamentals change significantly, you'll have a lot of the what we call the big dough investors lighten up on their technology exposure. I don't think we're anywhere near the fundamentals changing significantly enough for the big dough institutional investors to lighten up on their technology exposure. The only way that they would, if they have somewhere in their charter that they don't want a certain sector to be more than, let's say, 8 or 10% of their holdings, the higher Nasdaq goes, the higher the higher the market cap, the higher the price of these companies go. That means that their market cap expands because market cap is price times number of shares outstanding. And if the continued price rally creates a scenario where all of a sudden some of these big funds say, oh, well, now this infotech communication services part of my portfolio is up to 12 or 13%, they will want to scale back a little bit, still having a very large holding, but just so that that part of their portfolio stays within a percentage of what they want their charter says their maximum exposure for one sector should be. So that was the Nasdaq. Now the one part of the market that still has struggled, was hit the hardest during the coronavirus outbreak, and has struggled to get back to anywhere near where it was in February before the sell-off, is the Russell 2000. These are the small cap companies that have less access to big bank loans and cannot just go into the financial markets and raise capital easily by either selling stock or doing a bond offering. So it makes sense that these are the ones that in any different, yeah, John, I see your question. I'll get to it in a minute. Um, that in any different, any economic downturn, the small cap stocks are the first to get hit and and have the biggest trouble recovering. But they will if the economy is really going to get back online and we're going to get past the capacity constraints on airlines, restaurants, theme parks. We get the sporting events back in motion. Then you'll get more money uh, reverberating through the economy at a more typical multiplier effect that we're used to, and these companies will have an easier time. And a lot of them are emerging growth companies, so if they're in the right space, um, you'll eventually see, if we continue with the expansion, you'll eventually see these companies do a little bit better. The Russell was down 1.7 on the week. I'm sorry, the Russell was down 0.6% on the week, and it's down 1.3% on the month. Very different from the Dow, the S&P, and the Nasdaq. I mentioned the Nasdaq over and over again. It was up 4% on the week. It was up 5.5% on the month. I really don't think the Nasdaq is going to be able to add 4% every week through the month of July, but we'll see. I would also think that as we get further into the month, we're probably not going to have four out of five 1.5% moves by the Dow Jones Industrials. One up, one down, one up, toggling back and forth between up moves and down moves. And I say it was a crazy week. That's what I mean? Because it's just a week that absolutely will infuriate uh, uh, a lot of people who are market strategists and market commentators that talk on TV because they want to see a trend. And right now, the only trend that we're seeing is 1 to 1.5% moves almost every day. So there's a question here in the chat. What are your thoughts on the next round of stimulus? Larry Kudlow said he wants a more targeted focus. I think that that comment is well put. Clearly, when the at the early stages of dealing with the coronavirus and the economic shutdown, it was we need a big bazooka shotgun stimulus program that just pretty much hits everybody so that people through no fault of their own being out of work will still be able to pay their bills, buy groceries, etc., etc., etc. So they did the $1,200 stimulus checks, 2,400 for married couples, a little bit more for families, and then they did the additional federally kicked in $600 kicker per week for unemployment insurance. And now we're in a slightly different environment. We're 2.5 months beyond that, and we can see where uh, pockets of the economy are affected more than others. Some have had an easier time adjusting. Some areas of the economy and some parts of the employment sectors are struggling a little bit more than others. So when Kudlow says he wants a more targeted approach, that just means that they want to get some stimulus assistance to those parts of the economy, being people and or companies that warrant it and that really need it. Now, there's been a lot of different potential versions of this thrown around. It's still pretty much a jump ball. Yeah, I see somebody says here, I just want the tax cut. Yeah, I think a lot of people would like the tax cut. The problem, obviously, is with the Democrats controlling the House, getting it through Congress. Um, we'll just have to see how much muscle the administration wants to apply to that effort. And again, I think that will one way or another that will bring the tax issue front and center going into the election a little bit less than 4 months from now. So somebody's asking how is Tesla going to impact the S&P 500? Well, it's I haven't seen an announcement that it's being added to the S&P 500. I think that it's inevitable that it eventually will be. But we just have to see, like, when that happens. Um, Maybe it needs one or two more quarterly earnings reports before it would officially qualify. There's different outlooks on that. It's still a little bit hypothetical, um, but we'll see. I mean, clearly, it would probably make that index maybe a little bit more volatile given that it's a $1,200 uh, stock that can go up or down 100 points a day. And it would be, who knows where it would lie exactly within the capitalization range of the S&P 500. But, we'll address that question when and if it actually happens. But the other thing that I really want to do is take a closer look at the sectors of the market that outperformed and underperformed last week. And the reason I think that that's critically important this week is because this was the first full week of the third quarter and the first full week of the second half of the year. Everybody's performance numbers are in for the first half of the year. I think that people that commit money to big money managers will pretty much give almost anyone a pass for having a down first half of the year. Clearly, the coronavirus and the resulting economic shutdown caused major havoc with the economy, major havoc with the markets. And although markets snapped back much stronger and much faster than almost everyone anticipated, I think most people were probably still down for the first half of the year unless they were heavily, heavily overweighted in technology. Um, but we want to look at what the different sectors and pockets of the market did last week because I think it will give us a little bit of an input of where big investors are focusing for the remainder of this year. Because right now, this is all about performance for the third quarter and performance for the second half of 2020. There are still plenty of uncertainty to come. There's still a lot of variables involved, more so than usual. But let's look at what outperformed and what underperformed in uh, in the first week. Now we have mentioned there's 11 sectors in the S&P 500. Consumer discretionary was the strongest sector last week, up just less than 5%. So consumer discretionary means things that you buy, that you choose to buy, that aren't essentials, as opposed to uh, consumer staples. Consumer staples are things like food. And the classic example for the coronavirus would be, if you want to remember back into late March when we first had the shutdown, toilet paper, paper products, soap, toothpaste, etc. A lot of the stores ran out of basic essentials like that because people went to the store and bought up what they thought would be 2 weeks, 4 weeks, 6 weeks supply of all essentials, then saying, well, I won't have to go back to the store to get these things, especially if the whole family is going to be at home. We're going to use a lot more than usual. Um, and so, but now that people are going back to work, people probably saved a lot of money staying at home during the lockdown. They have a little bit more spending money than they anticipated, and there's probably a lot of pent up demand for items that people didn't buy for 6 or 8 weeks. So for consumer discretionary to be the best acting sector of the 11 sectors in the S&P 500 the first week of the second half, I view that as a positive sign that people feel um, like, okay, we're dealing with this. We're going to get through it. Oh, by the way, um, I haven't bought a couple of new shirts or whatever it might be in 3 or 4 months. Um, I got to get a number of things on my want list rather than just my needs list. So, consumer discretionary up almost 5%, followed by uh, telecom services and info technology. That is your internet traffic trade. Okay. That's anything that supports the increased traffic going through the internet. Those parts of the market are still very hot, evidenced by NASDAQ, by the move that NASDAQ has had now with a 6% cushion on the 10,000 barrier. Uh, Now, consumer staples up 2.5%. Okay. We did have um, some concerns earlier in the week and at the beginning of July that there were big outbreaks in geographical areas that had been much less affected in March and April. And maybe if people were, you know, Maybe if some businesses were going to be a little bit slower to open than we might have anticipated. Maybe a lot of people thought they'd be going back to work July 1st, and now they're not going back till later in July. They, you know, there was a trade into consumer staples also, even though consumer discretionary was the best acting sector in the market. So all the other sector that acted a little bit better than the market, and it is not, it's a big part of the market. It has not been a market leader for probably before the financial crisis in 0809 was the financials, the S&P financials. There were days when the big banks acted really well. There were days when they didn't act that well. I think that with talk of more stimulus coming toward businesses and even some of the loan programs that the Federal Reserve is sponsoring, those are going to be sponsored and funded by a combination of the Fed and the Treasury, but they're really going to be administered by the big banks. And that's going to be um, decent revenue stream for the banks, which really, in the aftermath of the global financial crisis and particularly the Dodd Frank legislation that followed that, there's this argument that I have supported on a number of occasions that big banks have really become pseudo regulated utilities. They have to go to the government to get approval to continue their stock buyback, to add to their stock buyback, and to raise their dividends. And they're not regulated as tightly as utilities are, but they're certainly regulate. There's a lot more regulation and oversight on the financials than there was um, before the Dodd Frank legislation. Also, very important, the one very positive piece of news that's helped the banks a lot over the last week and a half, and it either came out early this week or or in the middle to late the week before, was the Supreme Court decision that the Consumer Financial Protection Agency has to be reworked. This was the agency that was really the brainchild of Elizabeth Warren, that came into effect after it was an aftermath part, an add-on to Dodd Frank. But basically, it was designed in an incredibly autocratic way that the whoever was the head of the Consumer Financial Protection Agency, and it used to be this guy Richard Cordray, who ended up being the running for governor in Ohio and lost to DeWine, and then after that, there was a controversy when Trump appointed Mick Mulvaney to be head of the Consumer Financial Protection Agency. Well, he was also head of the I don't know if he was head of the Office of Management and Budget or whatever his role was at the time. Also, but he had two roles at the time, um, which has been typical of the Trump administration. A little bit of a sign that look, we're way too heavy in the bureaucracy, anyways. So the head of the CFSB, what Consumer Protection Financial Bureau Agency, whatever the exact title is, had total authority, and the entity itself had complete automatic funding that anytime they basically spent money or requisitioned money, the money would, whatever they requisitioned, would be just automatically transferred from the Federal Reserve, not even the Treasury, to that agency. So there was absolutely zero oversight from Congress. And allegedly, the head of the agency was totally independent of the executive branch and could not be replaced by anyone. And you remember when Cordray resigned to run for governor, the Democrats claimed that the number two person should be automatically elevated to that position. Uh, President Trump didn't view it that way. He put Mulvaney in that position. I think he won a court fight over it. But for the Supreme Court to say that that agency, which was created in a totally unconstitutional manner, needs to be completely reworked, was the correct decision. And that has helped the rally in the banks significantly. Okay. So let's take a look at a couple of the sectors that really underperformed. I mentioned that the Russell earlier, which is the Russell 2000. It's 2,000 of what you would call small cap stocks. It's the stocks in the entire Russell universe. The Russell's kind of like the S&P that range from market cap number 1,000 to market cap number 3,000. So they call it the Russell 2000. Anyone that manages a small cap money or has a small cap fund uh, typically benchmarks their performance against either the Russell 2000 or the S&P small cap index. So the Russell 2000 was down. I'm going to look at it again. 0.6% for the week. It's down 1.3% for the month of July. Definitely moving in the opposite direction of the larger cap indices. But let's also look at the S&P Mid Cap 400, down 0.34%. The S&P Small Cap 600, that really mirrors the Russell a little bit more closely, down 0.8%. That's very consistent with the Russell being down 0.6%. And it's very consistent with the idea that the smaller cap companies are going to struggle the most if the economy dips a little bit from some of the very positive economic data we've seen pretty much over the last 3 to 4 weeks, starting with the May job report that we got the first week of June. And then if that were to happen, the market would notice that the Dow has run into its 200-day moving average and backed off a number of times. Uh, the market might take a little bit of a dip also. I really think that if we get the economy back on track, we get through this big wave uh, of new coronavirus cases where, sure, we're doing a lot more testing. Sure, there were a tremendous amount of rallies and protests where people weren't uh, following social distancing guidelines, maybe even not also wearing masks. Sure, people are going outside a lot more. It is summer. If you're going to be in congested areas, and you're going to do a lot more testing, there's going to be people with positive cases. But if we don't have the hospital systems get overwhelmed and we don't have the death count go up and significantly, we're going to be able to deal with it and pretty much just fight our way through uh, some people getting the virus. And then if there's more positive headlines that maybe a vaccine is going to come sooner than it typically would, and or there are very effective treatments that people can be administered with to take if they end up being positive for the virus. I personally think that there are different strains of the virus going around. A lot of people will say that viruses always mutate a little bit. As time goes on, you get different strains, and as they mutate, maybe they get a little bit weaker. I think that a lot of people that are testing positive for the virus right now have much lighter symptoms and are getting a lot less sick than people that tested positive for it in mid to late March or early April. And if the economy continues to improve, but it will be, look, it's not going to be a glide path, but I think that the overall direction of the headlines and the news on the economy is going to continue to improve as we get through the month of July and through the remainder of the summer and into the fall. So these smaller companies will very likely come through this, although there certainly will be sectors that um, have a lot more issues to deal with than others. Clearly, the cruise lines and the airlines. The cruise lines were most affected. The airlines probably second or third most affected. People have to get comfortable to get onto an airline with the idea that they might be sitting in the middle seat of a three-row aisle, and the a flight might be sold out before the airlines are really going to be out of the woods. Now, look, bankruptcy is not a totally new concept for the airlines. There, most airlines have been in and out of bankruptcy two or three times over the last 30 years. So they can, just because some companies file bankruptcy doesn't mean the operation of that company completely grinds to a halt. It just gets uh, into a state of what a lot of people would call debtor-owned financing, or I'm not really saying it the right way, but you know what I mean. The airlines continue to fly. They're an essential part of the economy. So a few other sectors that really did not act well last week. The worst acting sector in the S&P was energy, which is ironic since oil did get through. Energy was down about 5% on the week. It had had a pretty good run coming into the end of the second quarter. Oil had gotten above 40, closed, I think, above 40 on either July 1st or July 2nd for the first time. Stayed above it for about a week, slipped below it for a couple days, but then on Friday closed back above 40. I think 40 is a very key level for the price of oil for a lot of the higher margin energy companies to be able to not just survive, but be able to be profitable. And we'll have to see how that plays out. Just to give you an idea, energy was down. It was down 4.6% on the week. It was down 4.8% on Thursday alone. And then on Friday, when oil traded back up above 40 and closed the week above 40, the energy sector was up 3.2%. So even with the 3.2% rally in the energy sector on Friday, it was still down 4.6% on the week, the worst acting of the 11 S&P sectors. Uh, S&P 5, the S&P industrials were also a trailing sector. They were down 1.4%. I'll mention real estate because a lot of people don't really, that's almost a misnomer. It's a confusing sector. 1.7%. Real estate is not necessarily home building. It's not necessarily personal real estate. It's not the home building sector and everything to do uh, um, with houses, house construction, or personal real estate. Frankly, I think everything to do with the home building, home buying, home furnishing, construction, and everything associated with it is probably one of the better areas of the market going forward, especially with mortgage rates as at all-time lows. But real estate really means REITs, and REITs really mean office buildings, shopping malls, strip malls, uh, and REITs right now. The big issue is that they have a tremendous amount of vacancies, a lot of huge 50-story office buildings in Manhattan are structured as REITs, owned by huge REIT companies. They have massive vacancies. A lot of people might be working at home a lot longer than had been initially anticipated. So the REIT sector, even though interest rates are very, very low on government debt, and people are really scrambling for yield. The REIT sector has a tremendous amount of exposure right now to um, from the uh, office buildings, strip malls. I'm sure if you go by strip malls, there are businesses that have not reopened or could not survive the downturn that we just had, and um, shopping malls, which had already been in a state of significant decline even before we got even before we got into this. So um, it's 11:40. Maybe we'll go for another 5 minutes or 5 to 10 minutes. If anybody has any questions, shoot them in here. I see a couple of questions popping in. Yeah, I have not mentioned. Um, if you're not subscribed to my YouTube channel, I would really appreciate people subscribing to the channel, The Anderson Report. I think it will come up. We've made a couple of adjustments. I think it'll come up much quicker in the search engine now. But it's The Anderson Report. That's the YouTube channel on YouTube that this broadcast will be on. It will also always be logged there. If you don't catch it live, you can go there and watch it after the fact. It's also connected to Periscope. Now, my Periscope account is, for some reason, and I can't remember exactly why, is just slightly different than my Twitter handle. My Twitter handle is TJ Anderson1. My Periscope account is TJ Anderson 12. Now, I don't know if I typed an extra digit when I set up the Periscope uh, connection, or if maybe TJ Anderson 1 as a Periscope account was taken by somebody else, or exactly why it is, but it is what it is. The Periscope is TJ Anderson 12. My Twitter handle is TJ Anderson 1. If you're watching this after the fact and you have questions about something I say, you can shoot me a message on Twitter. You can DM me if we follow each other, uh, and I will try to address all questions. Um, and I am also, this is the third episode. Uh, Typically, I'll do this during the week 2 or 3 times. It seems that the 7 p.m. hour is a good hour. Maybe people are home from work. Maybe it's not far enough like into the evening where people have had too long of a day. I may do one during the day on occasion if markets are extremely volatile or there's big news out that day. Um, but if people have suggestions, comments they want to, uh, things they want to address, um, I would just say that going into next week, uh, earnings season for the second quarter will start. A lot of people have completely written it off because we know that earnings are going to be very bad for the second quarter when the economy was shut down really for almost a month of it. But it, it it's still going to be a headline driven event. It's going to start with the big banks. And I think that what people will really focus on is what the banks have to say about going forward, what they think their loan commitment exposure is to big companies that may be having issues, and maybe how they feel about any of the Federal Reserve sponsored loan programs or programs that they're co-sponsoring with the Treasury, and or what their experience was with the PPP loans that were really a very well thought out lifeline for a lot of small businesses, and importantly kept a lot of people on employment rolls through that 2 month stretch. So that's pretty much uh, that's pretty much what I have today. I certainly appreciate uh, everyone joining us again. subscribe to the channel, hit the little like button on the videos, and we will see you sometime next week, probably Monday at 7 p.m.